Welcome to the MHP Exchange podcast, where industry veterans Frank Rizzo and Eric Busadil generously share their wealth of knowledge in their new podcast dedicated to the manufactured housing space. They tackle tough questions to provide valuable insights for those considering investments in mobile home parks. If you're seeking answers in the manufactured housing space, this podcast is your go-to resource.
Okay, so we're doing something different today on the MHP Exchange program. I'm your host, Frank Rizzo. I'm here solo today, and we're going to have an episode, and we're going to discuss what we've talked about and what we think are going to be the top 5 trends in the MHP space for 2025. Now, we did this program last year, and last year, Eric and myself, we had 8 different predictions, and 6 of them came out. 2 of them we were a little off on, and we'll discuss that a little bit later. But we're going to talk about what we see happening in the MHP space, in the MHP operation space, in the investing space, and things that we should be on the lookout for. So the first thing that comes to mind, and I think this is just in the commercial real estate sector as a whole, last year was a stabilization year. We had a huge drop off in 2023, over 60% of the transactional volume down from 2022. Last year, we sort of stabilized. We were down in the third quarter about 2% year over year. But as we entered the year, I think 2 things resonates with investors across the board. Number one, there's clarity. I think when you have an election year, it creates a lot of uncertainty in terms of which way the market might be heading. And I think having clarity is tremendously important for investors and for business owners. So having that clarity is huge. And in the conversations that you've had with other business owners, with other investors, there is a renewed sense of optimism now that we can put some of this bickering and strife behind us, and there's an optimism of where we're headed and what can be done. So I think we're going to see a bounce back and start to see the transactional volume increase. And we've already started to see that last year, where the volume had picked up towards the end of the year. And I think this year you're going to see a continuance of that. So do I think we get back to 2022 levels? Probably not. But I think we're definitely going to be off of last year's level, and we'll see an increase in overall transactional volume. So that's the number one prediction. Now, with that, right, I think we have to come to the realization. This is one of the things that we were off on. We thought we'd see a reset of some of the pricing in the manufactured housing space, and it's been incredibly resilient. That mobile home parks have maintained their value, and in some cases have even gone up in value, even though we were in a down market. Now, we have seen distressed situations, but we have not seen a distressed market where retail had been down, apartments have been down, office was down tremendously. Mobile home parks have essentially remained flat while the rest of the market was down. And why is that? I mean, that seems like there's a bifurcation of the MHP space and other asset classes in the real estate sector. And there's a couple of reasons for that. And one of the key differences that you have in the MHP space is that there's a finite supply of mobile home parks across the country. So depending on who you speak with, somewhere between 43 and 44,000 communities or parks throughout this country. So unlike other asset classes where you can build more retail, or you could build more apartment buildings, or you could build even more industrial, it is very few mobile home parks being built nationwide. So with the fact that there's a constrained supply, and there's still a tremendous amount of capital looking to get into this space, it's amazing. We were at the IMN conference this year or last year in Nashville, and I was speaking with a couple of different family offices that have been looking to get into the space, and it's striking how much capital has spent a significant amount of time, 2-3 years, trying to find either opportunities or sponsors or operators that they could get involved with. And so there's still a lot of capital looking to get into this space. And when you have, it's economics 101, right? When you have a limited supply and more capital looking to get into that, that's allowed prices to remain at its point, and it will allow pricing to go further. So I think that's the second thing that we should look at, is that capital is still going to want to get into the manufactured housing space, because inevitably we have an affordable housing crisis in this country, and that's a crisis that will not be easily resolved over the next 24, 36, 48 months. So as long as that crisis is still evolved, as long as there's more people looking for affordable housing, and mobile home parks are really, or mobile homes or manufactured housing is still the most affordable housing stock, that's something that will allow that a reason why more people will want to be putting more capital into that space, putting it to work to come up with those solutions. But I do think, and we will start to see a few, and we saw a little bit of this last year, I think we'll start to see a little bit more of that in the coming months. I do think that we're going to see some operators who fail. I think there's been a lot of, because of what happened in 2020 and 2021 with the low interest rate environment that we were in, it became the manufactured housing space, mobile home parks became a very compelling story as people were chasing yield. It caught the attention of a lot of people who weren't per se mobile home park operators, or thought the business was a little bit easier than it actually is. And with that floating rate debt that will get reset, I think some operators will find that their promote has vanished in resetting that debt. They'll find that banks are less likely to kick the can down the road. I know last year, a lot of lenders were focused in the office space, or regulators were focused on the lenders who were in the office space. They kind of put multifamily to the back burner. I think this year, more attention will be paid to it. So I do think if those people who have purchased communities or were operating communities and they haven't hit their numbers or their targets, I do think that you're going to see some distressed situations open themselves up. And I think that's a very, very key component. So that will create some opportunities in the space while those operators are having some challenges. So that is the third thing to look for. Look for those distressed situations when they do pop up. And part of the reason why you're going to see that, or part of the challenges that we've seen, is, because of the premise that you have a very tethered resident base. I know people like to call them mobile homes, but as we know that they're not very mobile. To move one of these homes is an undertaking. You have to hire a licensed mover. You have to get somebody to set the home. You have to reconnect to the plumbing and the electric lines. You have to reskirt the homes, put in decks, and the cost to do that type of move could be anywhere from 12 to 15 to 17,000. Most residents will stay in place if they're in a community that's well run, that's safe, that's clean, that offers value. And it did attract people who maybe did not do the work necessary to improve the infrastructure, to create the amenities, or give the resident the experience that they are looking for. And they did, maybe raise rents very aggressively. Maybe they overshot the market on communities that maybe couldn't afford it. And I do think that you're starting to see some pushback, and that pushback will continue in certain communities and you'll see a discrepancy between larger communities that might be able to attract people who are willing to pay a higher lot rent because they have some compelling amenities to be there or some value inside that community, to maybe smaller communities. Well, even though you might be in the same market, there'll have to be a divergence and a delta in that price that you're going to get for that lot rent. So you're going to see those. Even though I think some of those rent control initiatives have been pushed back or slowed down, I do think that they will still start to expand, and there will be a divergence between where you might, underwrite a lot rent to what you might actually get in reality. So I think as you're looking at your parks and you're looking at your communities, if you are planning to increase your lot rent, if that's part of your business plan, because maybe lot rents haven't been raised in, an extended period of time, 10, 12, 15 years, make sure that the value that you're bringing to that resident is equal to the lot rent that you're looking for that park to generate. So that's a big proposition that you have to be very conscious of when you're underwriting, when you're looking at that community. And I think that will cause that the operators who aren't paying attention to it, that will cause a continuance of these rent control measures or this pushback from the tenants or from in terms of what's happening there on the ground. And I think it also has caused some operators to rethink their strategy when it comes to park-owned homes and the rentals in that. There's been a push in bringing and moving up the number of manufactured homes that communities are bringing in. And I think over the last 4 years, you've seen that number start to increase. And I know there's a big push to break that 100,000 homes a year that's being created in the manufactured housing space. And there's been a push to do it, and I think we're almost there. So there's more of these new homes that are in these communities. And I think there's been a number of operators that have proven that when you have new homes on site, you can run a successful rental model. UMH being one of them, they run a very successful rental model. So it's something that's being looked at differently now than maybe it did 4 or 5 years ago. So as the industry changes and evolves, and some of that might cause some operators to pivot in terms of how they look at a park-owned home in their community based on the year, the make, and the model. So you want to be very conscious of that, because the brand new homes that are being brought in are really a higher class of home, and it's something to pay attention to. And the fifth thing that I'm going to note here, and something to watch, and something that got approved last year, didn't get talked about a lot, but I think it's going to have a big impact, if not this year, going into the next year as the market starts to accept this. Last year, HUD approved for the first time ever a duplex manufactured home. Now, the beauty of that is that same manufactured home where now you have a duplex in it, that's going to create a lot of, has the potential in the right market, has the potential of creating some additional value and income for the community. And I think that's something to watch, something that hasn't been talked about a lot. But I think this year, you're going to start to hear a lot more of duplex manufactured homes being brought into communities. I think that's something that if you're in a market and you're looking for ways where you can create additional income streams, that might be something to consider. So the 5 things that we have for you to pay attention to in your investment this year is: 1, volume is going to be up. I think the divergence between buyers and sellers, that delta is going to close. You're going to see more transactional volume. I think prices in the manufactured housing space are going to remain strong as we still see more capital looking to find home in that space. But again, number 3, watch who that capital backs. There is a lot of people who came into the space over the last few years because it became somewhat trendy, and especially when you start to see how resilient it's been in some very challenging times. But I think this is the time where those operators will start to create some separation, and good operators will stand out. And I think you're going to see some operators have some challenges. And then the rethinking of how we're underwriting and where lot rents are going is still going to create some, you're still going to have some challenges on the ground with some tenant groups that are happening. So it pays to be a good operator to create value first before you start to move rents, because that's, at the end of the day, it's the resident on the ground that we're trying to make those communities better for. And then finally, the last thing we're going to mention is take a look at those duplexes that have just basically come out last year. They were just HUD approved. I think they're going to surprise the market, and I think you're going to hear a lot more of them this coming year. Those are my 5 predictions for 2025. If you stick around, you'll hear more. This year, we have a very exciting year planned. We're looking to touch base with you guys more, and we think 25 is going to be a fantastic year in the manufactured housing space. This is Frank Rizzo from the MHPexchange.com and the MHP Exchange podcast. I'd love to hear your thoughts. Send us a comment on what you think your trends are in 2025 in the manufactured housing space. Put your comments below. I'd love to hear about them and talk about them. And who knows, maybe we'll make a program about it. But until next time, this is Frank Rizzo from the MHP Exchange and the MHP Exchange podcast. Happy investing, guys.